Hey, welcome back. One of the things we talk about in retirement planning is a very valuable tool called a Roth Conversion. And it may or may not work for you. I'm going to be honest with you. For some people, Roth conversions are really a very powerful and useful tool for later on in their retirement years or for estate planning. I've also run the numbers for people who have recently retired and looked at whether a Roth IRA would work for them in terms of a conversion. And I'll explain what all that means in a minute. You know that I'm going to get into, make this very simple and easy to understand. So don't worry if you don't know these terms yet, but hang around because this may work for you. It might not, but let's talk about it. And I'll give you the pros and cons of what a Roth conversion is. I mentioned in the last show we did that we have construction going on next door here in Windermere. They're building a new town hall and police station, and yesterday was apparently the groundbreaking. So we were trying to record with bulldozers and diggers, 12 feet from where I'm sitting right here, maybe 15 feet. So today seems to be a little quieter. I tell people who don't know Windermere that it sounds very fancy. My office address is 120 West 6th Avenue, which sounds very impressive, and if you were in Manhattan, perhaps it would be, but we're on a dirt road here. Windermere's this little community with lakes surrounding it, like 5 lakes all around us, the chain of lakes. And so the real estate, as you get down closer to the lakes, is very nice, but here in the town center, it's basically cinder blocks homes and dirt roads. So that's Windermere. It's a lovely community, but don't let the fancy address fool you, is what I always tell people. So let's talk about a Roth IRA, whether it's something you can work with or not. And to read the text I put up here, the Roth, anyone can convert to one. You can do it today if you want to, okay? Regardless of income, regardless of marital status. And prior to 2010, when these things first came out, they were limiting who could do those conversions. But now we don't have that constraint anymore. So let's talk about what a conversion is and whether it's something you want to look into. So why would you do it? So here's the difference. Your IRA, you made a deal with the IRS when you started it. You said, I'm going to take money I haven't paid tax on yet, and I'm going to put it in an IRA account, and I'll pay the tax when the money comes out. Okay, so the Roth IRA came along. It's named after a congressman from Maryland, and he came up with the idea that we would have a little different kind of retirement account where you take taxable money you've already been taxed on, and then you put it in this retirement account, and when the money comes out, it comes out tax-free. Well, that can be very powerful, especially if you're young, because when you are in your, say, 20s, they even have Roth 401ks now, where you can put a bunch of money in that's already been taxed, and then all of the years of potential compounding and growth on that money, when you get to retirement age, will come out on a tax-free basis. So that they're very powerful tools, as I keep saying over and over again. But there's also a thing called a conversion, where you're allowed to take your IRA account and convert it to a Roth. Now the rule is you have to go through the toll booth. You have to pay the tax as you convert. Now sometimes those numbers make it very compelling to do a Roth conversion. Other times not so much. The other advantages of the Roth IRA are there are no required minimum distributions. And as we talked about in the last video, required minimum distributions can become substantial if you have a lot of money set aside from your 401k or from IRAs that have done very well. You can end up kicking yourself into higher tax brackets just through RMDs. So we're going to talk about that in a minute, but for now, let's just say that Roths are also an advantage because you don't have to take the money out, and they will, it says could lower future income taxes. There's a pretty good chance it's going to lower your future income taxes when you compare them to a regular IRA. But doing the conversion, we want to look at numbers, and I have software that projects out through your retirement. And what we do is we say, okay, you're 67 years old. When does the break even for making the conversion to this Roth? And then is it worth doing or not? Because for some people, it never really makes sense. For others, it's a really good tool. So we're going to talk more about that in a second, but this is why you would think about doing a Roth conversion. And as I said, a Roth conversion is when you take your IRA account, your retirement account, and convert it to a Roth IRA, and you do that by paying the taxes. And if you're going to do that conversion when you're under 59 and a half, unlike a regular IRA, there is no penalty, okay, to take money out of your IRA because you're converting it to a Roth IRA. So it's maybe another one that I didn't list here, another advantage, but it's a pretty cool thing to know about. Now, don't forget, there are penalties and things for taking money out of a Roth before you're 59 and a half, so they're not letting you off, but it is a pretty good tool to use for that. Why wouldn't you convert to a Roth IRA? Well, like I said, you got to pay the tax. And we're going to talk more about that in a second, but know that if I, say, take $20,000 out of my IRA account and convert it to a Roth, then that means that I have to pay $20,000 worth of tax, or I should say income on $20,000 worth of that distribution. So anything you take out of your IRA anytime is considered personal income, regular income. Not capital gains, just regular income. So when you take that money out of the IRA and move it to the Roth, it's taxable. And a lot of times, if you don't have money to pay the tax on that, then you have to take even more money out of the regular IRA to pay the IRS, and that money is also taxed as income. So it may not work in every case. We usually like to see these conversions done when the tax is paid from other assets you have outside of your retirement accounts. Not always. Every case is a little different, but that's usually what we think about. Time. When you convert to a Roth, you can't take money out of a Roth without penalty unless that Roth has been established and been contributed to for 5 years, and they go by tax years. So it doesn't matter if you do it on January 1st or December 31st, and this is 2021, for example, that counts as the first tax year, and you have to have 5 tax years in before you can start to take money out of a Roth. So that's an important thing to know. The other thing is, with time, is the compounding. That's why these things generally work better with younger people, but we do them a lot for people who just retired, and I'll explain that in a second. Okay, and then the cost is that these conversions are irrevocable. So if you take the money out of your IRA, put it into a Roth, okay, now you can't change that. You can't say, you used to be able to, okay, you used to be able to do what they call a recharacterization. You used to say in January, you made this conversion, then your year changed and you realized that you didn't want to put that money in the Roth for whatever reason. Well, that's too bad. You can't go back and change it. So those are important things to know when you are deciding whether to convert the Roth. And like a lot of things in financial planning, for me, it comes down to the math. Does it make sense to convert or not? I have a dear friend and client who wanted to do Roth conversions, and we were looking towards the end of 2020 in December to do them. And when we set up the time to do it, we looked at the math, and the math didn't work. He wouldn't have broken even though if you waited until he was 90 years old, there was no exam or illustration that showed that it was advantageous to go to a Roth IRA for him. So, like I said, sometimes they're beautiful things, other times not so much. So, that you have to know that. And the other thing with these is that you have to be careful. I had a friend who had a business that had significant losses, and he thought he could take those capital gains losses or capital losses that he had and apply them towards the tax he might owe on doing a conversion. So he thought he could take like a whole bunch of money, like $100,000 out of his IRAs and convert it to a Roth because he could offset that with the gains that he had, and he can't. He could only do that for like $3,000 of that conversion. So it didn't work for him either. And that was a good catch on my part, because if he'd have gone ahead and done it without me, if he had just been doing this on his own, he'd be in a world of hurt right now because he'd owe a lot of taxes that he didn't anticipate having to owe. So you got to be careful how you do these things. All right, so we talked about Roths before, all right? There's no initial tax break, tax-free distributions. Only earned income can be contributed to a Roth, but you can convert. Okay, there's all the rules in case you need to review them. I just wanted you to see them. And then you can withdraw as much as $100,000 from a Roth if you have a COVID-related issue, but they're very vague about that, what that is, and I would be careful about that, okay? So now just so we know, those are the rules about a Roth. Of course, if you pass away, and we'll talk about this in another video coming up, there is no penalty even if you're under 59 and a half or under 5 years to take money out of the Roth, okay? All right, so the 5-year rule, again, this is a slide I used last time, is very important. Here's another slide I used last time, and this talks about tax planning. And I want to try to explain why we would do a Roth, because I've told you a lot of reasons not to, okay? So let's zoom in on the personal income tax bracket. Now, let's say I had a client that was married, finally jointly, and they had about $30,000 of adjusted gross income for the year. Now, we looked ahead, and if you remember last time we did an example of somebody like this, and we saw that down the road, with just a fairly normal growth rate on their investments, their required minimum distributions down the road were going to be $60,000, $70,000, $80,000 a year coming out of their IRA as taxable income. And so remember, you don't have to do these required minimum distributions ever from a Roth. So once we put money in there, we don't have to worry about taking it out. And if we did, it's tax-free. But also, those start at age 72. And it's based on life expectancy. So a lot of times where I do the Roth conversions is if I have somebody who's just retired, and say they're 65 or 66. And so each year we would take a little bit of money out of their IRA and convert it to a Roth. And we use this table right here as a guide. See how the 12% bracket? Well, let's say they had like $30,000 of adjusted gross income. We might take another 30 or 40, making sure we stay under this 80 so that we could convert that. And then down the road, see, when we have to take those required minimum distributions, the amount we're using, the percentage we're taking from the regular IRA will be less in terms of dollars because we've already taken some out. So that's when we use them. And we don't do them every year. We do them for 4 or 5 years and try to get down to a manageable level, with the idea being that, if I've got a whole lot of income coming in on top of my Social Security and my pension and whatever else is coming, that I don't want to pop up from the 12% to the 22% marginal tax bracket. And I explained marginal tax brackets in the last video if you need a refresher on that. So what we're trying to do is, this is the big one here. If we can keep from going to 12 to 22%, that's a significant tax savings. And if down the road we know you're going to be in at least the 22% bracket, with your distributions, then we want to try to do what we can now to get money out at a 12% taxable rate. And then once we put it in a Roth, it should continue to compound and compound on a tax-free basis. So that's why they're very powerful, and they can make a huge difference if they work for you. But it's not everybody that they work for. And it's this concept of the graduated income tax that we use. I mean, even if you're in the 22% bracket and you're taking, if you're single, say, and you're taking $85,000 of income, well then to do a Roth, it's not that bad to jump to the 24% bracket. But we don't want to see you end up later on in the 32% bracket. And plus, we don't know if down the road they're going to raise these brackets a little bit, because it seems like it's something that'll eventually happen. You can usually, in financial planning, count on higher taxes somewhere down the road. That seems to be a sure thing. So that's kind of why we do them. They may work for you, as I've said a million times already. I'm sure you're tired of me hearing it, but I've seen cases where they don't work. But when they do, it's a very powerful tool. It's like a hammer, right? A hammer works when you need a hammer. But if you need a screwdriver or a wrench, you probably don't want to use a hammer. This is just another tool in our toolbox of financial planning things, and may or may not work for you. So remember, we talked about Rmds. Okay, they begin the year you turn 72. That used to be 70 and a half. It's taxable income. It's based on the IRS Universal Life Expectancy Table. So the older you are, the higher percentage you have to take out. And those Rmds, once you have to take them, right, that money cannot be converted to a Roth. So if you have like our example, if you have a $60,000 or $70,000 RMD required to come out of your IRAs, then you're going to find that you can't convert that to a Roth IRA, but you could do it with other dollars. You could take your 60 or 70 out and then do another 30 or 40 as a Roth conversion if you want to. I haven't seen anybody do that. I don't see where it really makes sense, but you could. And you can also, don't forget, on those Rmds, you can use those for charitable contributions. So if you're going to be giving to charity anyway, and you have to take required minimum distributions, you might want to use those funds to donate to a charity. So that's kind of it. That's the basis for what we're talking about with Roth conversions. I use them frequently, but not as frequently as I said that you might think I do, because there are times you just don't want to do them. But I like the idea of somewhere down the road, we've amassed a lot of money for you or your heirs on a tax-free basis. And we're going to talk in the next video a little bit about what happens if you were to pass away, and or when you pass away. I mean, it's going to happen to all of us. And we're going to talk about a lot of different ways that your estate planning can be important to you. And I'm not just talking about estate taxes. I'm talking about making sure your money goes to who you want it to in the most tax efficient way possible. And Roths can be a big part of that. I hope this helped. This is kind of complicated stuff to talk about and try to simplify in just a short video. But if you give us a call, we can help walk you through your situation and tell you if it seems to make sense or not. Take care, and we'll be back in the next one to talk a little bit about estate planning. Thank you.